All right, let's continue our discussion of merchandising businesses. I have a true-false question here. It says merchandise is sold for $3,600. Terms FOB destination $210, net $30, with prepaid freight costs of $150. The sales amount recorded is $35.28. True or false? So what is the amount of the sale from the perspective of the seller? Well, the seller is just merely prepaying this $150. They're going to get it back. But if we're assuming that this buyer has good sense, they're going to take this 2% discount. Okay? So $3,600 is the list price, but we're going to multiply that by 1 minus the discount rate, which gives us 0.98 or 98%, $35.28. So what we have here is a true statement. $35.28 is the amount of the sale. So we're going to mark that as true. Okay. Next question says, a sales invoice included the following information: merchandise price, $12,000. Terms, 110 net EOM, that means end of month. FOB shipping point with prepaid freight of $900 to the invoice. Also says, assuming that a credit for merchandise returned of $500 is granted prior to payment and that the invoice is paid within the discount period, what is the amount of cash that should be received by the seller? Okay. Let's do this. Let's bring our calculator back over here. And so remember, even though this is only a 1% discount, this is implicit interest of about 18.4% roughly. So we're going to take this discount too. So this $12,000 here, we're not actually going to receive that full $12,000, or the seller isn't. Instead, we're going to multiply that $12,000 by 1 minus the discount rate of 0.01, which means 0.99. So we're going to multiply 12,000 times 1 minus the discount rate, and that's going to give us 11,880. Okay? But we're also going to get this, you know what, I'm going to skip to the $900 last. $500 is returned. So that $500 is based on the list price of that merchandise, but it also has to be multiplied by 0.99 because that is being returned and the seller's not going to get that money. So we're going to take $500 times 1 minus 0.01. This is 0.99. And that equals $495, but that's a subtraction. Seller's not going to get that because that merchandise was returned. And then finally, the seller is going to get this $900 in freight that they prepaid, $900. So if we get our calculator, 11,880 minus the $495 for the returned merchandise plus the $900, the final total that the seller is to receive is $12,285. So in this, I want to go back up to this true-false question real quick. This true-false question asks for the sales amount recorded. This question asks for the amount of cash, both for sales and everything else, which in this case we have to add 900 to it. If it had asked for the amount of sales, we would just subtract this 900 out, and that would give us 11,385, but that's not what the question asked us for. Okay? Okay, let's see what we have here. Looks like we have something a little bit involved. Okay, based on the information below, journalize the entries for the seller and the buyer. Oh boy. Both use a perpetual inventory system. Okay, so we have some columns here. 1, 2, 3. Okay. So A, B, and C, we have 3 different things that took place, and we need to journalize these entries from the perspective of both the seller and the buyer. Okay, so for A, I'm actually going to put the letter A right out here. You can read that. It is an A. Seller sold merchandise on account to the buyer. List price is $47.50. Terms $210, net $30. FOB shipping point. The cost of the merchandise is $28.50, and the seller prepays the freight of $75. Okay. So 2% discount, we better take that for sure. So, well, the buyer better take it. So that means the seller's not going to get the full $47.50. Instead, we're going to multiply by 0.98 because it's a 2% discount. And that gives us $46.55. And let's see, do we have what's the name of the company? We don't have one name. We don't have a name. So we're going to set up an account receivable, or the seller is going to set up an account receivable. We'll just put to buyer. And that's going to be a debit for $46.55. Yes, $46.55. So we're going to have a credit of $46.55 to what? Well, they sold merchandise, did they not? So we're going to say that's sales. Okay? Move this out of the way. The merchandise cost $28.50. So whether the seller got a discount on this or did not is irrelevant. This is the cost of the merchandise. So we don't have to make any adjustment to this. If it wasn't adjustment, it's already been made for us. Okay? So the debit is the cost of the goods sold. That's our expense item, and they're giving us that information. It is $28.50. So we'll have a credit for $28.50. And that's strictly going to be the inventory that we no longer have. Yes? Yes. Okay, and it says here that the seller, where is it? Seller prepays the freight of $75. So what we're going to do is we're going to add that to the account receivable that the buyer owes us, because it says that the seller prepays it. But if we look right up here, we acknowledge that the seller, they prepaid the freight of $900 up here, and they are eventually going to get that back. Okay, so we're going to add $75 to the accounts receivable that the buyer owes us, and since we prepaid it out of cash, we're going to credit cash. Okay, so we have 3 things for the seller. The buyer, go ahead and put the letter A over there, hopefully a little bit bigger. Well, what are they getting? What are they debiting? Inventory. For that same figure, $46.55. Hopefully you can read that. $46.55. And they are going to set up a liability, so that's an accounts payable, and we'll just say to the seller for $46.55. Okay, that's the first part of it. Now, the buyer is not concerned with, or they probably don't want to know what the cost of the merchandise is for the seller, but they are going to have to pay this freight charge. And what they're going to do is they're going to roll that into inventory. And they're going to be paying the seller, so they're really just adding it to the accounts payable that they've already set up. So 75 and 75. Okay. Now that's all we have to do for the buyer because we didn't have to account for the cost of the merchandise. The buyer will eventually do that when they resell it, but not yet. Okay, so that's it for requirement A. So let's look at requirement B. Looks like we're going to run out of space here. We've got a gap. By the way, if you printed off this handout, and I don't know that you have quite this much space, so you might have to go in and edit your document a little bit and add a couple of spaces here to have room to actually do this. Okay, because I think we're definitely going to run out of space. Okay, so B, it says buyer returns $700 worth of merchandise as defective, and the cost of that merchandise is $420. So from the seller's perspective, what do we have going on here? Well, we're going to use that liability account that we set up. I'm going to have to abbreviate customer refunds payable. Customer refunds payable. And then we're also going to reduce the account receivable that we have with the buyer. But we're not going to do it for the $700 here because it says they're returning it as defective, and we don't have dates, but we're assuming that this is before they pay the bill. So we're going to take our $700, we're going to multiply that by 0.98 because it's a 2% discount, and that gives us $686. That's going to be the amount for both our debit and credit. So we're debiting customer refunds payable to reduce that liability that we set up, and we are also reducing via a credit the account receivable to the buyer for $686. Okay. Now this merchandise is defective, but we're going to deal with that later. Not in this particular exercise, but that's something that the seller has to deal with on their own. So we're getting the inventory back, even though it might be defective. And our cost in that inventory, let's see here, move this a little bit, is $420. Cost of the merchandise is $420. So initially we're just going to put that back on the books at $420. And then we're going to credit our contra inventory account estimate returns inventory for $420 because we set that up initially with a debit as a reduction to inventory. Okay, so we have two things that we're doing from the seller's perspective. From the buyer's perspective, a little bit simpler. We're going to reduce the amount of the accounts payable that we owe to the seller with a debit for that same $686. But we also sent back merchandise, inventory, even though it's defective. It was on our balance sheet at $686. So that's the amount that it must come off the balance sheet for. And again, that's all we have to do for the buyer. So we have one fewer transaction for the buyer than as we do for the seller. Okay, I'm going to drop down here and look at C. Let's see here. It says buyer pays within the discount period. So we have to determine how much we're going to get from the buyer. So let's see here. We were originally going to get $46.55, but the buyer returned $686 of merchandise. So if we do that, it comes up to $39.69. But be careful, because the buyer also owes us this $75 here for the freight charges. So now we're going to go in and we're going to add that. That gives us $4,044. So we're going to get cash of 4044, and we're going to credit the total of the accounts receivables. The most of that was for merchandise. $75 is for the freight for the same 4044. And then for the buyer, well, we're going to debit the remainder of the accounts payable, which is that same figure for, I've forgotten what it is now. Let's see here. It was $39.69. $39.69 merchandise. That's the $46.55 minus the $6.86 plus the $75. And this is all part of inventory for the buyer. So $40.44. So the $40.44 is what we're going to debit. That relieves our obligation to the seller because we've paid him. How did we do that? We used cash. So cash is our credit for $40.44. All right, that's it for this video, and we're going to look at the income statement for a retail business in the next handout video.